Hi there. It's nice to have a chance to talk with you today about some of the emerging trends that we're seeing as we're analyzing the financial performance of businesses and what to expect for the future. In this mini webinar series, we're going to talk about, different emerging trends that we're seeing. And this particular webinar is going to address what we're seeing as the impact of inflation and commodity price changes on a company's financial performance. Nobody has a crystal ball. We don't know what's going to happen, but once we're through with this presentation, you're going to be able to develop questions and discussion topics that you can use to better understand future prospects for a company that you're analyzing. The inflation and commodity price performance impacts are real, and they are definitely happening. As the economy has recovered from the impact of COVID-19, concern has definitely turned to inflationary pressures. And on August 31st, 2021, the Biden administration increased its Q1 inflation expectation from its May estimate of 2% to 4.8%. Commodity prices have been all over the board for the last almost year. Those prices are believed to be a leading indicator of inflation. The thing about commodity prices is they reflect systemic shocks. So for example, when a hurricane hits, the price of water and the price of plywood go up. When you have a situation like COVID-19, there are all sorts of disruptions that businesses have to adapt to and markets change as a result of, and that impacts commodity prices. When we're measuring inflation, there are different tools that we can use to try to identify what we're seeing in terms of inflationary trends. The first one is the Consumer Price Index, CPI. That's the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. So it's the price that consumers pay for a set basket of goods and services that a consumer needs to survive. The Producer Price Index, or the PPI, is the average change over time in the selling price received by domestic producers for their output. In other words, it's going a step back from the CPI, and it's trying to identify what's happening at the producer level, the production level, so that we can have some kind of additional view into what might happen with the CPI in the future. There's another measure of inflation called the Personal Consumption Expenditure Index, the PCE. And this is what the Fed uses as its inflation indicator. The PCE includes a broader range of goods and services than the CPI, and the PCE uses a broader range of buyers. The other thing that the PCE does is it tries to anticipate the impact of consumers substituting lower price goods for higher price goods, and then tries to use that to develop an adjusted basket of goods, if you will. For example, switching out bananas for apples would be a simple kind of substitution that the CPE might do. The Fed believes that this measure of inflation leads to a smoother and typically lower level of inflation. So let's look at some of these measures of inflation that we're seeing right now. Here's a graph of the Consumer Price Index. This is published monthly. The July 2021 percentage was 5.4%. August 2021 was 5.3%. Essentially very little change. But you can see if you go to the website for the US Bureau of Labor Statistics and you look at this graph, you can pick specific items, for example, energy or electricity or apparel, to see how they are moving separately from how the overall CPI index moves. And this is something that is going to be important when you're thinking about the performance of a company, because you might want to look at specific categories rather than look at the CPI in total. But in any event, we're seeing the highest levels of inflation that we have seen since the 2007-2008 period. And while there was a slight decrease in August, that decrease was minimal. And in fact, the decrease between July and August was primarily driven by a reduction in airfare and a reduction in used car prices when you're looking at a month-over-month basis. Now let's talk about the PPI, the Producer Price Index. This again is looking one step back from the consumers, and it's looking at a business, looking at a CPI for a business, if you will. The July rate was 7.8%. The August rate was 8.3%. Clearly, we are seeing significant increase in inflationary trends as reported by the PPI. You can see the red line is the total, and the blue line is the total less food, energy, and trade. Again, this is an important graph to look at when you're trying to evaluate the performance of a specific business, because you can go to the website for the US Bureau of Labor Statistics, and you can click on specific categories that are of interest to the company that you're analyzing. This is the highest level of PPI that we have seen in 10 years, and it is clearly indicative of some headwinds that we should be prepared for. When you look at the personal consumption expenditure, this is published monthly, a little bit later than the PPI and CPI are published, and it is in the Personal Income and Outlays report. And if you look at the performance of the PCE, you will see that July of 2021 was 4.2%. So even though this is typically showing a lower rate of inflation and a less volatile inflationary trend, we are definitely seeing all three of the indexes, including PCE, showing us that we need to be prepared for inflation. And I also want to turn away from the broad range of inflation to think specifically about different commodity prices. And sometimes when you think about commodity prices, you think about agriculture and agribusiness entities. And that doesn't consider the full breadth of the impact of commodity price changes. Steel prices, for example, impact many companies, anyone who needs steel in their production process. Lumber price changes impact many companies, down to everyone that uses pallets. And wheat prices affect companies that use flour as an input. So it's really important that a company evaluates its reliance, large or small, on commodity inputs. So let's look at a few commodity price changes that we're seeing. This first price graph is for cold rolled steel and strip. And this is pulled directly out of the PPI data that we talked about earlier. But you can see that from January to July of 2021, the price of cold rolled steel and strip tripled. Now let's look at the steel futures prices on the Shanghai index for steel rebar. Now, this isn't quite the same peak up that we saw when we looked at cold rolled steel, but when you look at steel rebar, you see a lot of price jumping around, and certainly higher levels than we saw as far back as 2012 and 2011. Some of the other types of commodities that have experienced fluctuations would be, another example would be lumber. If you look at the 10 years of lumber futures prices, you can see that 2021 was a very tough year. Starting actually in 2020 and then continuing into 2021. And you can see that there was a big peak in the first half of 2021, and now it's dropped, but it still is at high levels compared to every period except a blip upward in 17 and 18. When you look at the price of corn, corn has significantly increased. We had a increase in the price of corn, let's say in the 2010 to 2013 period, because of the use of corn for the increased use of corn for ethanol. And then corn went back down around $4 a bushel for several years. And now it has come back up again. Corn is an input that you have in a lot of products, and it's something that you need to be aware of. And then when you think about corn versus the creatures that eat corn, let's look at corn and poultry prices. And one issue that we're seeing on the agribusiness side and the processor side is that the prices for corn and the prices for poultry are not moving together, and they're not moving at the same rate. So here's corn versus poultry, and now here's corn versus eggs, again, not moving together. And in this case, corn versus egg, you can see that the price of eggs is much flatter than the price of corn over time. Now let's look at milk prices. Milk prices are hovering right now around that $15 to $16 a hundredweight, sometimes up to 20. And corn is a big input in the dairy sector, and you can see that those graphs don't move together. Those price graphs don't move together, and the trend line for corn is going up faster than the trend line for milk. So these are examples of changing prices for specific inputs that companies need to produce their product. And I think that it is important to look at an example of how a relatively minor change in pricing can have a significant impact on a company's performance. Both inflation and changing commodity prices impact the cost structure of the business. Inflation increases costs overall. And so what we're going to look at is the impact of a 1% increase, a 3% increase, and a 5% increase. And these are non-payroll cost increases. And then we're also going to look at what happens if there are individual line items that are increasing more or less than the CPI or the PPI changes. So let's look at this company. The example that I have here is a company with $50 million of revenue, and it's been producing an EBITDA of $2.5 million, and it has a nice fixed charge coverage ratio of 1.25%. Now, let's evaluate the impact of a 50% increase in a key input and a 1% increase in non-payroll operating expenses. When you think back to the graphs that I showed you on commodity prices, it isn't unusual during this time period to see a 50% increase in the price of a key input. So let's just look at this example. We take a company from a 1.25 fixed charge coverage ratio to essentially 0. So while this company had been able to generate sufficient cash to service its debt, with the increase in the key input and the increase in operating expenses, that ability has evaporated unless the company makes other changes. If you look at the same 50% increase in key input and a 3% increase in operating expenses and a 5% increase in operating expenses, you can see that you are now confronted with a company that is operating below the level needed to be able to meet its debt service. So What does this do? Should we all just wring our hands and say that we don't know what's going to happen? No. What we need to focus on are the best practices that can help companies identify how to survive an inflationary period. And these best practices, these are things that different companies have more as part of their culture than others. But if there ever is a time to pull out the best practices, this period of inflation and commodity price fluctuations is the time. And the best practices that we're going to talk about are going to be related to client relationships, vendor agreements, the bid process, deposits received and provided for inputs, working capital management, line of credit structure, price volume variance, sensitivity analysis, and matrix analysis. So first, let's talk about managing the client relationships. This is a time when knowing profitability by customer, profitability by product, profitability by division or by location is really key. It's going to be important to understand which of the customers provide and which of the products you produce provide the highest margin for the company. And this doesn't have to be an exact science. Lots of times when we're talking with companies about beginning to prepare this kind of profitability analysis, they tell us that they can't, it's too complicated, and they don't have the time. But it's easy to start somewhere, and you can start to tick off the largest impacts to customer profitability or product profitability. You can always get better at this over time, but it is critical that today you know which customers and which products are making you the most money. You also have to manage the contracts with customers. Does the customer have the ability to increase the price that you pay? Is there an auto renewal of contracts? Are there renewal dates that you need to be aware of, and what are the escalation terminology impacts? So what I like to do is I like to take a spreadsheet and list all the customers and all of the different contract components so that I'm not blindsided by auto renewals without the ability to increase prices, or escalation terminology that worked 5 years ago but doesn't work today. At the same time that I'm looking at my contracts with my customers, I want to look at my contracts with suppliers. Do I have the ability to lock in prices? Are there some hedging strategies that I can use? Again, I want to be aware of auto renewal of contracts and renewal dates and escalation terminology. Just like I'm managing my relationship with my customers, I want to manage my relationships with my suppliers. And again, I have a spreadsheet where I'm going to list out my contracts with the suppliers, and I'm going to make sure that I know these key dates and key pricing factors. I also want to pay attention to the bid process. Sometimes the bid process software is not tied to the ERP system or other business management systems. So you're going to need to understand, are key input pricings updated on what schedule? What is the bid lock period? If you provide a bid today, how long is that price locked? What's the escalation wording during the bid period? If prices increase more than X, do you have an ability to redo the bid? You want to be aware of that type of wording. You want to understand the escalation wording for that period between bid acceptance and project start. You don't want to be locked into producing a product at a price that you bid 6 months ago without the ability to deal with current input prices. And then what's the proposed escalation wording for the contract? Once the contract is signed, if it takes 6 months to complete or a year to complete or a week to complete, what are your capabilities to increase pricing based on commodity price changes or inflation changes? It's also going to be important to consider deposits. If your customer is giving you a deposit, where is that going to be reported on the balance sheet, and how is that going to be treated on the income statement? You want to understand, are customer deposits reported in AR in one line item, or are they netted against each customer's account? And if it's an ongoing customer, what does netting a deposit against the AR mean? You also want to understand what deposits are provided to vendors and when and where those are reported on the balance sheet. And you're going to want to evaluate how deposits are treated within the BBC structure, the borrowing base structure, if you have an asset-based line of credit. The next area of best practices is working capital management. This is a time where accounts receivable, inventory, accounts payable, and operating cycle management are going to be key. You're going to have pressure every step of the way in the operating cycle, and you want to be able to manage that. You still need to be calling clients to make sure that they're paying their receivables on time. You want to evaluate inventory. Do you have too much, too little? Do you have it in a different category? And accounts payable. Are your supplier lines sufficient now that prices have increased? And what are the terms that you're going to have to meet? And then in total, the operating cycle management of the company, which feeds into the need that you might have for a line of credit. So when you're thinking about the line of credit, the sizing can be changing because of commodity price changes and because of inflation. Asset relationship limits could be problematic. Asset relationship changes, in other words, the relationship between AR and inventory might change based on what you need to do to manage your inventory. There may also be ineligible changes. If you're keeping more inventory on hand to try to take advantage of lower prices, you might end up aging your inventory past its ineligible date. You also want to think about how deposits are dealt with in the line of credit, and think about whether or not you're going to need temporary increases in the line of credit that would be tied to commodity prices. An additional type of analysis that people probably haven't had to do very much of over the last few years is price volume variance. And we need to do price volume variance on revenues and price volume variance on key inputs. The next type of analysis we need to work through is a sensitivity analysis. For this, we want to think about, what does a $1 change in a key input or a 1% change in costs mean to the business's profitability? So for example, a $1 per bushel change in the price of corn, a $1 change in lumber prices, a $1 change in flour prices. If you can evaluate and think through how a $1 change affects your business, that gives you a better step up for improving your performance. You also want to think about a 1% change in all non-labor costs. How does that impact profitability? You'll need to look at escalation clauses in contracts, such as lease or rental agreements. Are there escalation clauses that are tied to the CPI or tied to the PPI? When do they reset, both up and down? And you'll want to look at the CPI and the PPI categories that have increased at a faster rate. When I showed you the PPI graph for cold rolled steel, there are many other PPI components that you can look at that might matter more for one company versus another. And then the next type of analysis beyond price, volume, and sensitivity is a matrix analysis. And what a matrix analysis means to me is evaluating the number of combinations of performance that result in break-even performance. So what that means is you consider the number of combinations of sale prices, input costs, and company size or volume that result in break-even operations. And so when you look at this from a matrix perspective rather than a linear perspective, you can identify the number of opportunities a particular business has for successful operations. So ways to respond to inflation and commodity price changes. Let's say you've done some of this analysis and you've evaluated some of the risks that you have. Well, what we're seeing companies do is we're seeing them head in two different directions. One is the head in the sand. They believe that it's going to happen no matter what, so who cares? There's nothing that we can do about it, so we're just going to roll with it. The other approach that we're seeing is analysis and planning. And this is the time to invest in planning. Some people call it risk management planning, give it whatever name you want, but this is the time when you want to do things like look at sensitivity analysis, look at a matrix analysis of performance, evaluate your contracts, look at your bid processing, look at your pricing with customers and your pricing with suppliers. So when it comes to how does a lender respond to this trend, what a lender can do is look at monthly and quarterly changes in revenues, cost of inputs, delivery costs, and miscellaneous costs. Try to identify what is changing on a month-over-month or quarterly basis. And ask the company what they've developed. What has the company developed in terms of a sensitivity analysis, alternative strategies? Do they have a plan B, a plan C? And then working capital management strategies. Are they paying attention? Are they really working their accounts receivable? Are they analyzing their investment in inventory? Are they working their payables and making sure that supplier lines of credit are keeping up with the prices that they're paying for those same goods? And then finally, rough out an understanding of a $1 per unit change in revenue, input costs, and overall cost inflation, non-payroll related. And if you do this, you can identify the businesses that are going to have the higher risk of performance problems. So when we're doing a sensitivity analysis and contract evaluation with a company, we look for the impact of a $1 change in key inputs on net income, EBITDA, and fixed charge coverage. And we also are looking at what does an overall change in costs, non-labor costs of 1% mean to those same categories. So we make it simple for us to think about it and for the business to think about how are some of these $1, 1% changes impacting profitability. And we really want to evaluate the contracts with customers and with suppliers and prepare a schedule and keep that schedule updated on a weekly basis, monthly at the longest. And then a matrix analysis, we want to figure out how many opportunities we have for successful performance. The bid process management is something that I think oftentimes slips through the cracks. So we want to make sure that we're asking about when is bid software updated? What's the approval process for outgoing bids? What's the terminology related to the pricing from bid development all the way through contract acceptance and through completion of the contract? Working capital management, some of the things that you need to be thinking about: accounts receivable. If we have higher per unit revenues, that may mean higher accounts receivable levels. And there may be stress on the AR collection process because just like the company that we're dealing with is experiencing cost increases, the customers are experiencing cost increases, and it may be more difficult for them to pay you. From an inventory perspective, we're seeing higher levels of inventory due to supply chain concerns, and that impacts inventory unit size levels. And then we have the increase in cost, which impacts the per unit value. So now we're seeing a higher investment in inventory. And from an accounts payable perspective, we're seeing higher levels of payables because of supply chain issues and these changing prices. There's also more pressure to pay faster. As I mentioned earlier, it's very important to make sure that supplier lines of credit are keeping up with the current pricing. A $1 million supplier line of credit or a $10 million supplier line of credit that worked last year may not even be close to working this year. So you want to look at that so that all the reliance isn't being pushed to the line of credit. In terms of the line of credit, we're going to need to look at the overall size limits, the relationship between categories, and the impact on ineligibles. And these four items working together are going to be critical to the cash management of a company during these inflationary times. If you have any questions, you're always welcome to reach out to us at Focus. We also have a website, and on that website, you can find an insights page, which has articles on best practices, working capital management, and other types of questions or articles on other types of questions that you might have about a particular business's ability to perform during this time period. What I am showing you here is a list of cell phone numbers and email addresses for all of us at Focus. And you should feel free to reach out to any one of us and talk with us at any point in time about what you're seeing and from a company perspective, even if we're not involved with that particular company. And also, if you would like a deck of this presentation, please email one of us or email info@focusmg.com, info@focusmg.com. And with that, thank you for joining me, and I look forward to the next presentation.